Hey guys, Jeff with optionboxer.com back today with another video. Going to talk about this defined risk reward expectancy calculator that I have on the screen here. Before we do, please know I'm not a registered financial advisor, and this video is not a recommendation for you to buy or sell any security or attempt any trade. Please make sure you're doing your own research prior to trading. With that out of the way, I've got Tastyworks pulled and I've got this defined risk reward expectancy calculator pulled up. Let's take a quick look at what this is. In order to use this particular risk reward expectancy calculator, you're going to have a defined risk and a defined reward. It can't be like a long call because we don't know what the potential reward is. The potential reward on a long call or a long put is possibly infinite. Now, if your long calls and long puts are anything like mine, they almost always go to zero. So it's not really something I trade a lot. But regardless, you're going to want to start off by entering your commissions round trip. If you trade on Robinhood, that'll be zero or maybe a couple of pennies just for regulatory fees. And then these four boxes here are the data that you'll need to collect and populate in order for this calculator to work. And we'll look at all four of those momentarily. You got the credit, the debit, the probability of profit, the strike width, which is $1, $5, $2.50, whatever the market allows for. I think 50 cents even, and the probability of loss, which is POL, and then the max profit and the max loss. The probability of profit can be found on Tastyworks right here. If you're in Thinkorswim, it becomes a little more difficult to find, but let's take a look. You'll have to go to the Analyze tab up here, Risk Profile, and you'll have to set the slices to break even. Now you can see that the probability of this finishing in the money is 52%. The probability out of the money is 47%. And so that's why I've got Tastyworks pulled up. It's a little easier for us to be able to see the probability of profit as it stands. And then, of course, these calculations will all happen based on the data that you enter here. And if this trade that I made right here were real, you can see the expectancy over 100 trades would be particularly ugly. And I think once you see some of these hypothetical trades built in here, you're going to be a little bit shocked at some of the trades you yourself and I myself have made in the past, and kind of the expectancy of those trades over a longer time period. Because we may make a trade that looks like we're getting a 37-cent credit, but if you type it in here and you look at that trade based on the probability of profit and the probability of loss over time, you're looking at a negative expectancy. And anytime there's a negative expectancy, it's not worth your time. It's not worth my time, and it's not worth the time trading it. Now, yeah, you may have some success trading the spread, and this particular trade, I may be able to send it on its way, and it may become profitable, but that would just be one of the one of the 55% chance that this is going to be profitable. But the more times you make this one trade with these particular metrics, the more likely you are to lose long term. And just to kind of give you a picture of what I'm suggesting, think about a coin flip. There's only two sides to a coin, heads and tails. So if you flip that coin, let's say 10 times, it may land on heads 7 times, and it may land on tails 3 times. Does that mean there's the 50% probability of it landing on heads and the 50% probability of it landing on tails is untrue? No, because there's only two sides to the coin. It just means that for that 10 flips, for that sample size, it only landed on tails 3 times instead of 5. But if you extrapolate that out over 100, 1,000 flips, or 2,000 or 10,000 flips, the more likely you're going to see a return to the 50% heads, 50% tails. The same thought process holds true here. But let's build a couple of these. If I'm entering a credit spread, which would be a bullish put spread or a bearish call spread, I'll want to enter that amount here. If I'm entering a debit spread, I'll want to enter that there and leave that blank. And then, of course, the probability of profit. So let's look at SPY. That's a heavily traded instrument, one that I trade quite a bit. Let's take a look here at 54 days out. And right now the market's closed, and so these numbers aren't particularly accurate. You can see that bid-ask spread is nowhere near true, because if you've traded SPY before, there's a much tighter bid-ask spread than that. But let's take a look at it. But let's look at receiving a 67-cent credit and probability of profit being 55. It is a $1 wide spread, and you can see over time this would hold true. Would hold a positively expectant value. So let's talk just very briefly here about the 50% target and the 65% target. Well, the 50% target is suggesting you close at a $33.50 profit or you close at a $16.50 loss. If you close at a 43.55 profit or a 21.45 loss, you could get filled at this price. This would be a really good trade. And you can see if you made this exact trade with this probability of profit and this probability of loss for 100 trades, you'd be sitting in a pretty good spot. If you closed at a 50% target, you're looking at $1,093. If you close at a 65% target, you could look to make about $300 or $250 more. And then if you held to expiration and neither closed only closed at maximum profit or let it expire at maximum loss, you'd be looking at $1,935. And so you can see if you could set this trade up 100 times, that would be beneficial to your account. Now, more realistically, you're going to end up finding trades that look like this one, where you get a $35 credit and with a probability of profit of 55. And you can see over time that becomes much more unacceptable. But the reason this 50% and 65% are beneficial is because you can see if you do close at a 50% target loss, over time you're going to lose less money. So it's going to kind of smooth out the the equity curve over time. And so when you lose, you're going to lose less, but when you win, you're going to win less. So you're going to make less over time. And you can see here at a 65% target, of course, you're going to lose more. That's all this calculator is designed for, but there's a lot of power in seeing it represented here, seeing the number as it's calculated out over 100 trades. So let's build a couple more. SPY right now, these numbers are just not reliable. You can see that bid-ask spread is crazy. But if you had a $53 credit, now you can see that is you got a 54% probability. Now you can see this would be a trade that over time would be a good trade, but it's 54 days out. So in order for you to make 100 trades at 54 days out, it's going to take you a while to make this $435. This is only calculated for one contract, one trade, and it's giving you that one trade 100 times, or it's calculating it out over 100 trades. Hopefully that was helpful. We'll look at one more trade, maybe on a less liquid market, or possibly maybe a less efficient market would be the hope. And let's look at 19 days. You can see 23 cents. Now this is what you're going to run into more often, is trades that look like this one. You can see it's got a 59% probability of profit and 50% probability is 68. And that's calculated. That 68% probability of 50 is calculated into this as well. And so you can see here that this would be a particularly bad trade if you set up 100 of these trades. Well, your account is it's death by 1,000 cuts. But watch how this changes with some small changes in the price. So let's go to 25. You can see it changes quite a bit there. You're looking at about a $200 difference just by getting a $2 credit. Let's change it by $10. Even $10 at this probability of profit doesn't get you to a positively expectant trade. You would have to up this by $43. So you have to get 20 cents more in credit at a 59% probability of profit for this to become remotely relevant. I really like this expectancy calculator, and I hope you guys do too. It is available on my Option Boxer Analyze and Journal spreadsheet. For those of you that have picked this up and have used it, thank you from the bottom of my heart. Thank you for buying it. I've put so many hours into making this spreadsheet, and I want it to be useful for you. So if you ever have a question, for those of you that have purchased it, please do reach out to me. I know many of you have, but for those that haven't, if you need something, please ask. Feel free to reach out to me at jeff@optionboxer.com. All right, guys, thanks for watching.